This week on the Retirement Quick Tips podcast, I'm recapping the third quarter of 2024 in the markets and the economy, and then looking ahead to the end of this year. Now, today I want to talk about what's happened so far this year. So kind of taking a look at where are we at right now with the economy and the various markets. Basically, if you look at your portfolio right now, you are pretty much at or near the all-time high watermark. Your investments have never been worth more than they're worth today. And that's because looking at the quarter and also how the stock markets and the bond markets have performed for this year, if you go from January 1st through the end of the third quarter on September 30th, what you'll see is that S&P 500 is up about 21%. Bonds are up about 4.5% in aggregate. And if you have even short-term CDs, money markets, the yields are still in the 4.5% to 5% range, even now that the Fed has started to cut rates. So if you have a blended portfolio, you're probably up somewhere around 8, 9, 10, 12% for this year. And then that's coming off of the heels of a really good 2023, where you saw S&P was up 24% last year. Bonds were up 5.5%. Now, sort of a general pattern that I see is that lots of growth. 2019 was a good year. 2020 was a good year. 2021 was a good year. So we had 3 years of strong growth coming out of the depths of COVID. It was, a very sharp but very brief drop in that. But the last 19, 20, 21, all very strong years of growth. 2022, big declines because the Fed started raising rates. And then we spent basically all of last year clawing out of that hole from 2022. And so 2024 has basically been a year of growth and reaching new all-time highs when it comes to portfolio values. I see it every day with client portfolios. And if you look at the data and the numbers, that's what you see. So stock market's doing very well. Now, earlier in the year and last year too, it was a really unbalanced stock market. You had basically the biggest tech names known as the Magnificent Seven as a group. They basically been the drivers of the market, and a lot of the other stocks in the S&P 500 and the overall US markets haven't been doing as well. But there's been a shift recently, and it's been a more balanced growth in the overall markets, where you're seeing sectors like financials and industrials, utilities, even pockets of real estate starting to now outperform and do better. So what's driving the market, there's an old saying, it says, don't fight the Fed. And for better or for worse, what the Fed has started to do in lowering rates, which they just did that for the first time in a few years, in early September, they cut rates by 0.5%. The Fed and what they're doing there, that's really the driver. That's the driver for the economic growth and anticipation, I guess, of growth, not necessarily growth itself. But the fact that the Fed didn't raise rates more and choke the economy more, now they're starting to ease a little bit, cut rates. That is definitely driving stocks. It is driving bond prices as well. So bonds are doing well. That's basically the story. They're trying to maintain this environment of stable economic growth. And as the markets anticipate further cuts from the Fed in the coming months, that should help to stimulate things like housing, some other interest rate sensitive sectors, and all areas of the markets as well. So if we're summarizing sort of what's been happening this year in the economy and the markets, I would say it's a pretty stable market environment right now. There's some momentum moving in the right direction. Yeah, there's some risks that we could still fall into recession, and those are real risks because the economy, even though it's growing, it's not growing that much. It's barely kind of plugging along, which makes sense because if you look at a lot of sentiment, like how Americans feel about the economy, they don't feel great about the economy. And I mentioned this yesterday, is that there's a lot of inequality right now. People who have assets, people who own stocks, they own their house. They have assets, a positive net worth, they've largely benefited in this environment. People who have a lot of debt, especially debt that's variable rate, like credit card debt, you're seeing a lot of signs of stress among Americans. The positive side with the economy, at least, is the labor market is on solid ground. Now, there are some signs that there is weakness there, but so far we haven't seen a jump in jobless claims or a big jump in layoffs. And so that's encouraging. The problem that I have with the labor market, though, at the time, maybe I'm going down a rabbit hole, but I've talked about this before. A lot of the new job creation has not been in the private sector. It's been in government jobs, healthcare, and education. And so that is not going to contribute long term to any real economic growth. So that is a bit concerning as well. But the labor market is normal. I think that's all I want to say about the recap right now. Bottom line is it's always all about the Fed, isn't it? That's not good. That was what drove markets lower in 2022. And that is what has propelled markets forward for the most part. That's maybe an oversimplification, but we can't deny the importance of the Fed and the trend of lowering interest rates that we're now in. And you cannot deny, if you look historically all the way back decades, 40, 50 years back, in what happens to the economy, what happens to stocks, what happens to bonds in an environment where the Fed is cutting rates. You can't deny that it should be a boost for markets and hopefully the economy in the coming months as well. That's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.